Here's something that should worry every American with money in a bank account. A few weeks back, one of the most powerful banking executives in the country stood up at a private industry gathering and dropped a bombshell that barely made it to the mainstream media. We're talking about someone who runs one of the largest financial institutions in America, someone who has access to data and trends that most of us never see. What did he say? That over the next 3 years, somewhere around $6 trillion might flow out of traditional American banks. Not might get stolen, not might disappear in some financial crisis. Just leave. Voluntarily. Because people and institutions are finding better places to park their cash. 6 trillion with a T. To put that in perspective, that's roughly 30% of all the money sitting in commercial banks across the United States right now. Gone. And the crazy part? This exodus isn't being driven by fear or panic. It's being driven by math. Pure, simple mathematics that anyone with a calculator can verify. Traditional banks are paying you basically nothing on your deposits, maybe 0.1% if you're lucky, while alternative digital options are offering 4, sometimes 5%. Same safety level, same liquidity, but 40 to 50 times more return. Once enough people figure that out, the shift becomes inevitable. Now, you might be wondering what any of this has to do with Bitcoin or cryptocurrency. Here's where it gets interesting. Exactly 2 years ago, in January 2024, something happened that most people didn't fully appreciate at the time. The Securities and Exchange Commission, after fighting it for over a decade, finally approved a bunch of applications to create Bitcoin exchange-traded funds. These are investment products that let regular investors buy exposure to Bitcoin through their normal brokerage accounts, the same way they'd buy shares of Apple or Tesla. One of those funds launched by BlackRock, the world's largest asset manager controlling over $10 trillion in investments. Their Bitcoin fund is called IBIT, and here's what nobody predicted. In just 24 months, that single fund attracted over $70 billion. $70 billion in 2 years. That's the fastest growth to that scale in ETF history. Not the fastest crypto fund, not the fastest alternative investment. The fastest of any ETF ever created. It grew faster than gold funds, faster than tech sector funds, faster than anything Wall Street had seen before. Think about what that tells us. This isn't retail speculators throwing money at meme coins. We're talking about pension funds managing retirement money for teachers and police officers, university endowments responsible for billions in institutional capital, insurance companies with strict regulatory requirements. These are the most conservative, risk-averse investors in the entire financial system. And they're allocating serious money to Bitcoin through BlackRock's fund. Why? Because the old playbook stopped working. For decades, the standard investment strategy was simple. Put 60% in stocks, 40% in bonds. The bonds provided steady income and stability. They balanced out the volatility from stocks. This 60-40 split was gospel in the investment world, taught in every business school, used by every wealth manager. But that playbook relied on one critical assumption, that bonds actually paid you something meaningful. After 15 years of near-zero interest rates following the 2008 financial crisis, bonds became basically worthless as income generators. A 10-year Treasury bond paying 2% when inflation is running at 3% means you're actively losing purchasing power every single year. The 60-40 portfolio became obsolete. It just didn't work anymore. So institutional investors started searching for alternatives, real estate, but that's illiquid and requires active management. Private equity, but that has high fees and your money gets locked up for years. Commodities, but those don't generate any cash flow. And increasingly, they started looking at Bitcoin, not as some get-rich-quick speculation, but as a portfolio diversifier with low correlation to traditional assets. Here's what that means in English. When stocks go up or down, Bitcoin often moves independently, sometimes in the same direction, sometimes the opposite, but always with its own rhythm. That's exactly what you want from a true diversifier, something that zigs when everything else zags. The data back this up. From 2013 to 2023, Bitcoin's correlation to the stock market hovered around 0. Perfect diversification material. But here's the problem institutional investors faced. They couldn't just buy Bitcoin directly. Regulatory constraints prevented most pension funds and endowments from holding cryptocurrency on their balance sheets. Boards of directors worried about custody and security. The operational complexity of managing digital assets scared away risk-averse institutions. The barriers were too high. They needed something familiar, an ETF, something they could purchase through existing brokerage accounts with normal settlement and custody arrangements. Once BlackRock provided that vehicle in January 2024, once they removed all that friction, the floodgates opened. In the first week of this year alone, IBIT saw over $800 million flow in. That's not cumulative since launch. That's one single week. 800 million. Larger than most hedge fund launches in history. And this wasn't some isolated spike. The money just kept coming. Month after month, institutions kept allocating. By early 2026, over 700 institutional investors held positions in IBIT according to public filings. State pension funds, university endowments, insurance companies, wealth management firms, corporate treasury departments. Wisconsin's state pension fund put $29 million into it. Michigan's pension system allocated $95 million. The Arizona Public Safety Personnel Retirement System invested $19 million. These are cops and firefighters' retirement funds going into a Bitcoin ETF. Let that sink in for a second. The most conservative money managers in America, people responsible for making sure retirees can actually retire, are buying Bitcoin through BlackRock. Not because they're gambling, because their mathematical models tell them it improves their portfolio outcomes. Now, here's where this connects back to that $6 trillion warning we started with. At the exact same time that Bitcoin ETFs were exploding, something else was happening quietly in the background. Bank deposits were declining. According to Federal Reserve data, commercial bank deposits fell by hundreds of billions in late 2025. Where did that money go? Some moved to money market funds chasing higher yields. Some went into treasury bills directly, and an increasing amount went into something called stablecoins. Most people have never heard of stablecoins, but they're about to become as common as debit cards. Here's what they are. Digital dollars, cryptocurrencies pegged one-to-one with the US dollar and backed by actual reserves. You send someone 10 USDC stablecoins, they receive exactly $10 worth of value. The stablecoin companies hold real dollar reserves, usually in treasury bills, to back every digital token they issue. It's like having a dollar in your bank account, except it lives on a blockchain instead of in a bank database. Why does this matter? Because stablecoins can pay you yield, real yield, 4 to 5% annually, based on the interest earned from those treasury bill reserves. Your bank account pays you 0.1%. A stablecoin backed by the exact same asset, US Treasury bills, pays you 40 to 50 times more. Same risk, same government backing, 40 times better return. Once regular people figure this out, once the technology becomes accessible enough that anyone can use it, the $6 trillion shift starts to look not just possible, but inevitable. Let me explain how banks actually work, because most people completely misunderstand this. You walk into a bank, deposit $1,000, and you think the bank puts that money in a vault with your name on it. You think when you come back to withdraw it, they pull out your specific $1,000 and hand it back. That's not even remotely how it works. Banks operate on something called fractional reserve lending. When you deposit $1,000, the bank keeps maybe 100 in reserve. The other 900 gets loaned out immediately. Someone uses it to buy a house. A business uses it to expand. A corporation uses it to build a factory. The bank charges interest on those loans, usually anywhere from 4 to 20% depending on the type of loan. That's how they make money. The spread between what they pay you in interest and what they charge borrowers. The system works smoothly as long as not everyone wants their money back at the same time. On any normal day, maybe 2 to 5% of depositors need cash. The bank keeps enough reserves to handle that normal flow. The other 95 to 98% stays deployed in loans generating interest income. But what happens when that assumption breaks? What happens when 10 or 20% of depositors want out simultaneously? We literally just saw this movie in March 2023 with Silicon Valley Bank. SVB had roughly $200 billion in deposits, mostly from tech companies and venture capital firms. They invested that money in long-term treasury bonds and mortgage-backed securities when interest rates were near zero. Then the Federal Reserve raised rates aggressively, from 0 to 5% in 18 months. Bond prices crashed. A bond paying 2% interest when market rates hit 5% becomes worth way less than its face value. SVB was sitting on over $15 billion in paper losses on bonds they thought were completely safe. When depositors got nervous and started pulling money out, the bank had to sell those bonds to raise cash. They had to realize those paper losses into actual losses. The losses wiped out the bank's capital. Within 48 hours, Silicon Valley Bank went from operating normally to completely insolvent. Regulators seized it. The 16th largest bank in America collapsed in 2 days. $142 billion in withdrawal requests in a single day that the bank couldn't meet. Now imagine that dynamic playing out across the entire banking system, not because of crisis or panic, but because customers rationally chose higher yields elsewhere. It doesn't happen all at once. 3% of deposits leave in month 1, 5% in month 2, 7% in month 3. The numbers compound, the exodus accelerates. Banks start losing their cheapest funding source. They have to replace customer deposits with expensive wholesale borrowing from other banks or the Federal Reserve. Their profit margins compress. The spread between what they earn on loans and what they pay for funding shrinks. Stock prices fall. Credit ratings drop. Borrowing costs increase further. It becomes a feedback loop. And here's the detail most people miss. When deposits leave, the loans don't disappear. If a bank lent out $900 billion backed by customer deposits and those deposits flow out, the bank still has $900 billion in loans on its books. Those loans don't mature for years or decades. A 30-year mortgage doesn't mature for 30 years. But the deposits funding that mortgage can leave in seconds, a few taps on a phone. The only way to replace deposits quickly is borrowing from other banks or the Fed's discount window. But that borrowing costs way more than deposits. And if multiple banks are competing for the same wholesale funding simultaneously because they're all losing deposits to stablecoins, interest rates spike dramatically. This is a liquidity crisis, not a solvency crisis. The banks aren't insolvent. They have good assets, performing loans, treasury bonds, investment-grade corporate bonds. But those assets are illiquid. They can't be sold quickly without massive losses. And if a bank can't fund itself in the short term, it doesn't matter that long-term assets are valuable. The bank fails before those assets mature. We've seen this before. 2008. Lehman Brothers, Bear Stearns, Washington Mutual, banks with hundreds of billions in assets that collapsed in days because they couldn't fund themselves when confidence evaporated. The difference between 2008 and what's coming is the trigger. Back then, the crisis got triggered by bad assets, subprime mortgages defaulting, mortgage-backed securities becoming worthless, asset quality deterioration. This time, the assets are fine. U.S. Treasury bills, prime residential mortgages with excellent credit borrowers, investment-grade corporate bonds from blue-chip companies. Asset quality isn't the problem. The problem is deposit flight driven by yield competition. And the trigger isn't crisis, it's innovation. Better products offering higher yields with more convenience. Banks understand this completely. That's why banking industry lobby groups are fighting regulatory approval of yield-bearing stablecoins. That's why executives are warning about trillion-dollar outflows. They're not fear-mongering. They're acknowledging mathematical reality. But the momentum is already too strong. BlackRock's 70 billion Bitcoin ETF proved institutional demand exists at massive scale, and BlackRock isn't stopping there. Let me show you what BlackRock is really building, because the Bitcoin ETF is just phase 1. Larry Fink, BlackRock's CEO, has been remarkably open about his vision since 2023. He's called Bitcoin digital gold in multiple interviews. He's predicted that blockchain technology will fundamentally transform financial markets over the next decade. He's talked about tokenization of real-world assets being the next major wave. These weren't casual comments. These were strategic signals about where the world's largest asset manager is heading. Tokenization means taking real-world assets like stocks, bonds, real estate, commodities, and representing ownership through digital tokens on a blockchain. Instead of holding a physical stock certificate or an entry in some centralized database, you hold a digital token representing the same ownership rights, but with dramatically better functionality. Why does this matter? 3 reasons: speed, cost, and accessibility. Traditional security settlement takes 2 business days. You sell a stock Monday, the transaction settles Wednesday, money hits your account Wednesday afternoon. With tokenized assets, settlement is instant. You sell, you get paid, done. No waiting, no settlement risk, no counterparty exposure. Traditional securities have high transaction costs. Brokers charge commissions. Clearinghouses take fees. Custodians charge storage fees. Every intermediary adds cost. Tokenized assets eliminate most intermediaries. Peer-to-peer transfers on a blockchain. Direct ownership. Fees drop from dollars per transaction to pennies. Traditional securities have restricted access based on wealth and geography. Many investments require accredited investor status. Net worth over $1 million excluding your primary residence, or annual income over 200 grand. Minimum investments of 100,000 or more for private equity, hedge funds, real estate partnerships. Tokenized assets can be fractionalized. Own 1/10 of a commercial real estate property. Own 1 share of a private equity fund. Own 0.01 Bitcoin. Democratized access to previously exclusive investments. BlackRock has been building this infrastructure systematically. In March 2024, they launched something called BUIDL. It's a tokenized money market fund built on the Ethereum blockchain. Institutional investors buy tokens representing shares in the fund. The tokens are programmable, instantly transferable globally around the clock, and can be used as collateral in decentralized finance applications. The fund invests in cash, treasury bills, and repurchase agreements. It yields approximately 5% annually, and it settles instantly. As of late January 2026, BUIDL holds over $700 million in assets. Now connect the dots. BlackRock operates the largest Bitcoin ETF at $70 billion. They have tokenized money market funds operating on Ethereum. They have relationships with every major institutional investor globally through existing fund businesses. They manage more assets than any competitor. And according to multiple industry sources, they're applying for federal stablecoin licenses. Imagine a BlackRock-issued stablecoin launching later this year or early next year, fully backed by U.S. Treasury bills, held at regulated custodians, yielding 4.5%, distributed to holders, available through every broker, every wealth manager, every financial advisor that already distributes BlackRock funds, which is basically everyone. Institutions trust BlackRock more than any crypto-native company. If BlackRock offers a stablecoin with institutional-grade custody, regulatory compliance, transparent auditing, and competitive yield, adoption will be massive and immediate. That's the master plan unfolding. Bitcoin ETF proves crypto demand and generates $70 billion in assets. Tokenized funds prove blockchain infrastructure actually works at institutional scale. Stablecoin provides the on-ramp for trillions of dollars to enter the digital asset ecosystem. And once dollars are in that ecosystem earning yield and operating on blockchain rails, they don't flow back to traditional banks. They stay digital, moving instantly, operating globally, outside the traditional banking system entirely. This is why BlackRock's $70 billion Bitcoin ETF matters so profoundly. Not because $70 billion transforms anything by itself, but because it's the proof of concept unlocking everything else. It proved institutional demand existed. It proved regulators would approve. It proved custody solutions worked. It proved the market had appetite. And now the infrastructure is being built systematically to capture those trillions that banking executives see leaving. So what does this mean for you? For your actual money? First, if you've got cash sitting in traditional bank accounts earning basically nothing, you're losing significant purchasing power to inflation. With inflation running at 3 to 4% annually, your $100,000 becomes $96,000 in real purchasing power after 1 year. Over 5 years, you lose $18,000 in real value just by holding cash in zero-yield accounts. That's real wealth erosion happening silently in the background. Once yield-bearing stablecoins become available through mainstream platforms, which is happening this year according to announced timelines, moving a portion of your cash holdings makes mathematical sense. Not all of it, not your emergency fund that you might need tomorrow, but savings beyond immediate needs, money earning nothing in checking accounts, cash sitting idle in brokerage accounts. The risk profile is nearly identical to bank deposits. Stablecoins issued under federal charters get backed by treasury bills. Treasury bills get backed by the full faith and credit of the United States government. Same backing that protects your bank deposits through FDIC insurance. Same risk, 40 to 50 times higher yield. Second, If you work in traditional banking, understand the structural shift happening. Banks will need fewer physical branches as customers shift digital first, fewer traditional roles. But that doesn't mean banking jobs disappear entirely. They evolve. Digital asset custody, blockchain infrastructure, tokenized securities operations, stablecoin distribution, crypto compliance. These are growth areas where skills will be increasingly valuable. Third, if you're an investor evaluating where to put capital, the companies building infrastructure for this transition will capture enormous value. BlackRock, Coinbase, Circle, the company that issues USDC, which already went public last year. These are the infrastructure companies of the digital asset era. They don't take price risk on volatile cryptocurrencies. They collect fees on transactions, custody, distribution, steady, predictable, high-margin revenue as adoption scales. Fourth, if you're young and early in your wealth-building journey, the financial system you'll interact with in 10 to 20 years will look fundamentally different from what your parents used. Learning about digital assets, blockchain technology, decentralized finance, smart contracts, tokenization, these aren't optional curiosities anymore. They're essential financial literacy for the coming decades. Like learning to use the internet in 1995. Not everyone understood it then. Everyone uses it now. Digital assets are following the same adoption curve. Start small if you're interested. Open an account with a brokerage offering crypto exposure if you don't have one. Allocate 1 to 5% of your portfolio to Bitcoin through an ETF like BlackRock's IBIT, not because Bitcoin will definitely skyrocket, but because portfolio theory suggests holding uncorrelated assets improves returns over time. When yield-bearing stablecoins become available through your brokerage, test them. Move a small amount. Understand how they work. See the yield accumulate. Verify you can move money in and out easily. Build confidence before committing larger amounts. Don't overallocate to any single innovation. Don't bet everything on crypto. This isn't about speculation or getting rich quick. This is about adapting to structural change in the financial system, the same way you adapted from cash to debit cards, from paper checks to online banking, from physical stock certificates to electronic brokerages. Evolution, not revolution. Stay informed about regulatory developments. This space moves faster than traditional finance. What's true today might change in 6 months. Follow primary sources. Read actual SEC filings, not just headlines. Understand underlying mechanics, not just marketing claims. And ignore the extreme voices on both sides. Crypto has evangelists claiming it solves everything and will replace all traditional finance within 5 years. Wrong. Crypto also has skeptics claiming it's entirely worthless and will collapse to zero. Also wrong. The truth sits in the middle. It's technology. Some applications will succeed massively, some will fail completely. Your job is understanding which is which through analysis, not emotion. Here at Next Generation Finance, we're committed to helping you navigate these changes with facts and data, not hype or fear. Let me bring this full circle. That warning about 6 trillion potentially leaving the banking system over the next 3 years isn't isolated speculation. It's connected to everything we've discussed. BlackRock's success with their Bitcoin ETF proved institutional demand for crypto exposure is real and massive. That proof opened regulatory and institutional doors for everything following: stablecoins, tokenized assets, blockchain infrastructure, yield-bearing digital dollars. Once that infrastructure is fully built and operational, once yield-bearing stablecoins are available through every major brokerage with familiar interfaces and regulatory protections, the 6 trillion deposit shift moves from theoretical possibility to mathematical inevitability. Not because banks are bad or failing, because innovation provided objectively better alternatives: higher yields, lower fees, instant settlement, programmable money, 24/7 global access. Better products win. Markets decide. Customers choose based on value. This is the biggest transformation in finance since the internet enabled online banking in the 90s, possibly bigger. Because online banking changed the interface and customer experience, blockchain changes the actual infrastructure, the rails, the settlement layer, the foundation. Banks that resist will slowly shrink. Banks that adapt and position themselves as infrastructure providers will survive and potentially thrive. Companies building the new infrastructure will capture enormous value as trillions migrate to digital rails. And individuals who understand this shift early, who position appropriately, who build relevant skills, will have significant advantages in the financial system of 2035. BlackRock's 70 billion Bitcoin ETF didn't directly trigger anything, but it proved the concept, making everything else possible. It legitimized institutional crypto adoption. It demonstrated that trillions in institutional capital wanted digital asset exposure if given proper vehicles. And that legitimization enabled the stablecoin revolution, the tokenization wave, the 6 trillion deposit migration. It's all connected, all part of the same transformation. And it started with one ETF 2 years ago that most people dismissed as a niche product. The next 90 days will be critical. Multiple catalysts are converging. More regulatory approvals, mainstream platform integrations, institutional adoption announcements. The 70 billion proof of concept is complete and validated. The 6 trillion migration is beginning. And the biggest structural shift in finance since 2008 is happening right now, in real time. The question isn't whether this happens. The question is whether you understand it early enough to position accordingly. If you found this analysis valuable, smash that subscribe button and hit the notification bell because we're tracking every development in this transformation. Drop a comment below telling us whether you think traditional banks will adapt or get left behind. The conversation is just getting started, and your perspective matters. This is not financial advice. Always do your own research and consult with qualified professionals before making investment decisions.